Hi there, welcome to Earnings, the Option Pit Method, trading stocks and options after earnings. 1 second. For those of you that don't know who I am, my name is Mark Sebastian, and I am the founder of Option Pit. We are a education and consulting company. We are the best in the business, second to none. What really differentiates us is we are not an education firm. We are a group of traders who teach other traders how to trade. That's the way I learned, and that's the way we run things. So when I was a trader on the floor, I would teach young kids how to trade. And, funny, I taught one kid how to trade, and he eventually replaced me because he was cheaper. But I come from a long tradition of traders teaching other traders, and that's kind of really what our company is founded on, is the same principles. We service every kind of client. We have clients that are worth $10 billion. We have clients that are worth, $10,000. We also run a hedge fund, and we're going to be rolling out our second one here shortly, called Carmen Line Capital. So we are unique in that we are traders who teach. We are not educators. I think that's a major differentiator and part of the reason why you want to do business with us. So volatility can act like a headwind or a tailwind to successful trading. We're going to talk about some very, very basic buy-sell decisions. I'm going to talk about the analysis of expected stock movement ahead of earnings, analyzing post-earnings vol moves, and then we'll look at some post-earnings trades. I'm sure there were some stocks that had earnings this week. If you guys have some ideas, we'll look at a couple and I'll tell you what I think and how I might trade it. And this is my favorite one. I get this every earnings season at least once. And it goes, Mark, market makers are cheaters. I bought these calls right before earnings. The stock is way higher, but I'm not making money. Market makers stole my money. They took my money. All right? And the answer is no one took your money. The stuff that goes into the pricing your options, all right, the theoretical value, what produces the value of that option, changed. All right, the volatility changed. All right, there are 5 factors that go into pricing an option. Does anybody know what those 5 factors are? Anybody know what the 5 factors that go into an option's price are? Well, they are price of the underlying, strike price. No, those are the Greeks, Rohit. It is price of the underlying, strike price, timed expiration, cost of carry, and forward volatility. Well, guess what? After earnings, perceived forward volatility changes, doesn't it? Right? Do stocks move more the 2 weeks after earnings, or do they move more the day after earnings? Right. So after the earnings come out, guess what? Something changes. And thus your calls change. Thus you lose money. So there are 3 main types of volatility: realized, historical, and implied. Each one is useful. We can look at AZO. Ask me at the end of the webinar. All right, so let's start with realized volatility. Realized volatility is how much a product is moving right now. All right, so what's happened in the last day, or the last 2 days, or the last week. All right, it's an immediate move. While every move ends up being kind of historical in nature, I look at realized as kind of what's been happening right now. All right, now a decent measure of realized volatility is going to be like 10-day historical volatility. That's okay. It's not great. It's hard to really measure what's happening right now other than to just look at the stock. But 10-day HV is not bad. You know, and here's an old 10-day HV chart in Google. And you can see it's been moving. And take a look. Here was earnings, and guess what? It made a big move. Right? All right. So next up we have historical volatility. Historical volatility is how much the underlying has moved in the past. And it can be viewed in all sorts of increments. It can be viewed in 10 day, 20 day, 30 day, 60 day, 100 day. There are all sorts of ways of measuring historical volatility. And historical volatility, what it really does is measure through a calculation called GARCH, kind of how the closing price moves every day. All right, that's where that volatility is derived from, and it tends to be mean reverting, which is important. So the white line is 10-day historical vol. The blue line, the light blue line, is 20-day. And the dark blue line is 60-day. And what do you notice about those lines as we add more time? What do you notice? It's flatter. Yeah, it becomes more flat, right? It's more mean reverting. It's more smooth the more time you add, and that's the key. That's what really shows that mean reversion. All right, so now let's talk about implied volatility. This is the most important one for traders. It measures how much the market is expecting the underlying to move. All right, so you know the model wants us to use forward volatility. Does anybody here know the forward volatility of a stock? Any stock? No. So the model wants us to use something we don't know. So what we really do, that's a price, not a vol. So what we do is look at the other four factors and the price of the option, and we actually solve for implied volatility. So if you look at the model, right, you've got the option price equals the strike price, and obviously it's a big differential equation that you're using, and you've got a variable now in there, and you've got the strike price, price of the underlying, cost to carry, timed expiration, and then the unknown is volatility. So what do? We move volatility to this side, and we move option price to this side, and we solve for volatility. That's what creates implied volatility. It's actually a very complex form of algebra if you want to think about it that way. So implied volatility changes as the option price changes. Does that make sense? Great. Then I'm doing my job. So this is the VIX of Goldman Sachs. All right, that light blue line is the 200-day moving average. What do you notice about it? flat as a pancake. Right. What causes that? Mean reversion. Good job, Joe. It's mean reversion. Right. Mean reversion causes it. So really the key, over the long term, we know where the implied volatility of a stock or index is going to go. All right? We do not know where the stock price is going to go. Implied volatility is mean reverting, and that is key. So, does anybody have any, but what about MMM and the price of a straddle? Don't they know IV in order to determine these? Actually, the straddle is determined and that produces the IV, not the other way around. So trading creates the price, and then out of that you pull the implied volatility. Now, looking at implied volatility, I can tell when things are really cheap or really expensive. But it's just like buying art, or you go into a garage sale and you see a Renoir, and they don't know it's a Renoir, and they've got it for sale at $100. Or you go into an art dealer and they've got a Renoir for $100 million, and that's too expensive. So implied volatility is really, if you think about it as art, it's relative to, you can look at implied volatility and say relative to historically where this art has traded, where is it priced? But it's really all about where that art is trading. Where are those options trading? Does that make sense? Any questions on volatility and implied volatility? Any questions on that? Because it's important to understand that. So now, let's talk about the straddle. Somebody brought up the straddle. Let's talk about the straddle. So let's talk about earnings. The key to understanding earnings is to understand straddle price. The straddle is the market's best guess at how much the underlying might move between now and expiration. It's about 80% of a standard deviation. All right. If it's not dead on, then what to use? Well, we're going to talk about that. And what about the volatility crash? We're going to talk about that. It doesn't always happen. So the key to understanding earnings is the straddle price. The straddle is, again, the market's best guess. All right. An at-the-money straddle price of a weekly option ahead of earnings is going to give you the market's best guess on how much the underlying is going to move on earnings. 58% of the time, the underlying is going to move about as much as the straddle or less. That straddle is rarely dead on, but over time, its average price tends to be accurate. Straddles, if you do 100 earnings straddles in the same stock over 100 quarters, over time, that straddle is going to be about right. It'll be off every single individual earnings by some amount, but over time, it'll tend to be right. Does that make sense? All right, good. All right. We do have some questions. What if no weekly options? Well, then you have to do monthlies, and they're a little less accurate. News also. News, not unexpected news, is typically not priced into the straddle. All right. And if there are no weekly options, then you have to use the monthlies, and that you also have to then take into account what's going to happen after earnings. And one way to look at that is, okay, what did the month before price when there wasn't earnings, and subtract that value from your earnings straddle. And that'll give you a good idea of what the earnings are. So for instance, let's say that like earnings are going to be September 1st. And the August straddle had been priced $2, and the September straddle was priced with the same timed expiration was priced $5. So what kind of earnings moved are they kind of pricing into that straddle then? What do you think? Right. I'm getting $3. Right. That's about what they're pricing in. So that's one way to kind of end around it. It's not as good as looking at the weekly straddle, but it's not bad. So here's an example. This is from Lululemon right before they had earnings. So you can see this is actually the day of, because here's the after hours move. So the weekly straddle does a decent job of guessing the move most of the time. More often than not, the underlying move is less than the straddle is predicting. All right, more often than not. 70% of the time, the straddle is overpriced. However, when the straddle is wrong, guess what? It's really wrong. And so that's how things equal out. When it's wrong by a lot. When it's right, when it's too cheap, it's too cheap by a lot. When it's too expensive, it tends to be too expensive by a little. Does that make sense? So the at the money straddle, 57.5, is pricing a move of about $6.20. With the stock trading 57.50, it's about a 12% move. So the next step is to look at the actual move in the market. Did the stock exceed or disappoint the straddle? All right. Depending on the move, one approaches these very differently. It also depends on the change in vol. So scenarios, all right. The straddle outperforms. What is the stock doing and what is IV doing? The straddle underperforms. What is the stock doing and what is IV doing? So what happened to implied volatility on an outperformance? What happened to implied volatility on an underperformance? What did the stock do? Straddle outperformance. If the straddle is up a lot and IV is not in much, so they don't sell volatility a lot, the stock is going to keep going up. And that's because traders are chasing calls because they overwrote. Do we all know what I mean by when I say overwrote calls? All right. Overwriting is when you are long a stock and you sell calls to create income. All right. So I'm long Apple and I sell the 165 calls to create income. Well, Apple has earnings and it blows higher to 167. Well, guess what? The overwriters, I will. Mark, clarify IV is not in much. I will. So overwriters are then they don't want to lose their Apple stock. So what do? They go buy calls. Yeah. So all of these option sellers are buying back their stuff. And when option sellers are covering, that pushes the stock higher because there are two ways to cover. One, buy the stock to deliver on the short calls. Two, cover your calls. Either way, there's buying demand. Buying demand means implied volatility stays higher. Does that make sense? Here's Apple. And Apple had a big outperformance here. See that? Here was vol before earnings. And what I want to point out is here's about 30 days to earnings, right? Here's when implied volatility starts to pick up on earnings. And after they tank vol, after they quote unquote sell off premium, guess what? I want to show you this. Take a look here. Look how high this implied volatility is relative to where Apple was trading. Yes, it's cheaper, but does it seem elevated relative to where Apple options were prior to the beginning of the earnings vol buildup? Does that seem slightly more expensive? Yes, John, it does. All right, so now, how do you trade it? How do you trade it? Well, take a look. Typically, when you get a huge outperformance and vol not coming in, you'll get a fade and a follow. It makes this like little mini V. And that's how you trade. So what I always suggest doing, all right, is let the stock pop and then buy near the close the next day, or buy options near the close the next day. So you're buying options here. All right, or you're buying the stock right there. Because what's going to happen? You're going to get this little fade, and then you're going to get a run. That is, you would be shocked how often that pattern shows up when the volatility pops. So when the stock pops and volatility stays a little firm, you're going to get probably a little bit of an ease back, and then buy, because that stock is going to keep going. Almost certainly, that stock is going to keep going. So now, what if the stock is down a lot and IV is not in much? Right. So what's going to happen? Generally, the stock is going to keep going as traders chase puts to set up hedges. However, it's more confusing on the downside. All right. Generally speaking, when implied volatility stays firm on a big sell-off, there will be follow-up movement. It may not be in the same direction. So when there's a big move higher and volatility stays firm, that stock's going to keep going up. When there's a big drop and volatility stays firm, that stock is going to keep moving, but it might be up or down. Does that make sense? On outperformance. Right. So if the straddle is $5 and Apple is down 8, something's going to keep happening. So here's advanced auto parts, right? You get this huge drop. Vol stays firm. Right? But take a look what happens. It moves a lot, but it moves higher, not lower. So in these cases, in generally speaking, if I get an outperformance and the stock is up, I buy calls. If I get an outperformance and the stock is down, I'll do like a short iron butterfly where I buy the straddle and sell the wings. How low would it have to be not firm? Well, that's where things get it can be a little confusing. You have to kind of know the stock. I don't trade in stocks. I don't really have a good idea on how they trade. So I keep a close eye. Actually, Advanced Auto Parts, when I watch, when the volatility didn't get completely wrecked and it was still way above what's over here, I said, okay, this thing's going to keep moving. Here's Campbell's Soup. They reported a week ago. Take a look here. Straddle price was, let's say, 130 and 160. So we'll say $2.90. Well, I'm going to say that this thing moved more than $2.90. Down to 46 bucks from 50. It moved $4. That's a decent outperformance, right? And the options stayed a little bid. You know, instead of being around 19, they're around 22. That's a decent difference. So that would be one I'd be interested in doing some sort of iron butterfly. You know, this is off the top of my head. Let's take a look at what Campbell's Soup has done since. It's recovered $1.30. All right, we'll wait for that to come up. So now here's one. So now what if IV is completely crushed? What if they kill vol? If a stock pops and IV gets murdered, this denotes excessive call selling. Buy calls. Again, people that sell calls on strong up moves lose almost all the time. Short covers will race. Buy calls. If the stock tanks, and this is more what I like, and implied volatility gets murdered, this is one I do almost unilaterally when I see this. So a stock drops and they just destroy implied volatility. What does that mean? Well, why would implied volatility get murdered and a stock just drops? What's happening? And I put it out there. I actually wrote what it is, but you tell me what's happening. Yeah, people are selling the stock instead of hedging. They don't want to own it. Right? When implied volatility drops on a major sell-off, guess what's happening? They're just selling the stock. They're not even bothering to hedge. That means they think the stock's just going to keep dropping. Does that make sense? So here's IBM. And IBM is a consistent buy that continued lower. So take a look. Here's one. IV actually gets lower than where it was before earnings. And guess what happened to the stock? Same thing here, right? They tank the stock. The vol drops. And guess what? Keeps going lower. Quite possibly the easiest put purchase in the world. I do some writing for thestreet.com. I put 2 different put buys out. Both were big wins. So now what if the straddle underperforms on earnings? this is a lot easier. So if the stock underperforms on earnings, and implied volatility gets smoked, it's probably going to keep going in that direction. Follow the direction. Here's an example of Google. And I would point toward this one. Here's one where Google underperformed its straddle, and they kind of smoked vol. Guess what? Buy puts. Here's one where it outperformed, and they killed implied volatility. Guess what? Kept going higher. You see how easy it is actually when you think about it? It's not that hard. BABA, same thing. Straddle underperforms. It keeps going higher. If you pay attention to what was expected and what happened after and what happened to implied volatility, there is more opportunity in trading post-earnings, far more opportunity in trading post-earnings than there is pre-earnings. One of my hopes of you coming out of this is that you stop trading pre-earnings and you start trading post-earnings. If you do that, even if you don't buy anything, I will feel fulfilled because I will have made the world a better place for the 100 people here. Do you check the straddles right before and after earnings? Yeah, that's the key. Yes. All right, so I'm gonna let us pick a couple of. So I will, Gerald. I'll get right back to that. So I'm going to tell you what I've got coming up, and then we will pick some stocks to look at, and I'll answer questions. So this next Thursday, a week from now, we are doing professional approaches to directional options trading. You go to optionpit.com/direction. We're going to sell it in our store for $297 on the Friday, a week from Friday. But you can attend live for $197. Now, here's going to be the little secret for just us. All right, so I put the 25_off code on there, and that's what's going to go out in the email. But if you're attending live, there are two things you can do. One, you can subscribe to optionpit.com, and our Option Pit Live students get all of these webinars for free. It comes with their subscription. Or I'm going to give you a little secret code that is only for the people live now. Use code CANDLE70 and it'll take $70 off the price instead of $25. So you can pay $125 and you get access to our chat room. You get access to our daily strategy letter. You get access to stocks to watch, and you get this next upcoming webinar free. Super great value. Or if you don't want my chat room and stuff like that, use code CANDLE70 and it's just $127. And it's actually on a Thursday, not on Saturday. Thursday the 14th at 7 Eastern time. And it's going to be about 3 hours long, and it's going to be a brand new course, and we're going to dig in a lot of stuff. Now that CANDLE70 code is only going to be good until tomorrow. And it's only for people that are here live. You go to optionpit.com/direction, you use CANDLE70, or like I said, buy the subscription, you get it for free anyway. It's just CANDLE70, no underscore. Yeah, it's next Thursday, not Saturday. How much is the subscription? $125 a month. So you actually are still paying less. You're paying $125 instead of $127, and you get a bunch of extra stuff. Well, thanks, John. It's going to be what time again? It is right here, 7 p.m. Eastern Time. All right, now, will this course also address post-earnings trades? We're going to address all sorts of stuff. When you leave, you will have actionable ways of approaching trading. This is going to be the single best 3 hours that you can spend to trade directionally. I mean that wholeheartedly. I mean it so much that if you take the course and you say this is worthless garbage, I'll give you your money back. And if you take the course and you say, hey, I decided I want the subscription instead, I'll rebate you $2. Think about that. $2 whole. That's enough to buy like a pack of Garbage Pail Kids. Or baseball cards. All right, so feel free to ask about the subscription or anything like that. You can go to optionpit.com/mentoring to sign up for that. But we do have some questions. What if IB drop is back to IB 30 average and straddle underperformance? You know, I've never seen that. Typically, if it just goes to kind of normal, that might be a big stay away. If it's something that you don't understand, don't trade it. That makes sense? Straddle underperformance is the straddle is looking for a $5 move, and the underlying only moves $3. All right. TOS does have IV on graphs. It does. All right. So now we had some people that wanted to look at RH. So let's just take a look at Campbell's. It dropped and is now starting to move. So it had earnings. You can see that straddle worked. So if you bought your straddle here, you'd have bought the 45 straddle. This is Campbell's. Remember we were talking about this? So on Friday, the next day, I might have bought the September. It's trading 45 and a half. 45, 46 strangle for 90 cents. Well, guess what? Is the 45, 46 strangle for 90 cents winning right now? Or 95 cents? Yeah, it is. You see what I mean? That strangle jumps from 95 to dime, and we'll call that 170, $1.80, so it doubles. I like to at least wait until the next, so earnings are on a Thursday or on a Wednesday night. I wait Thursday and then trade Friday. Sometimes I'll trade Thursday, but I'm a professional. You guys wait. Generally, I would wait till Friday. That makes sense? 2 days. All right, so now everyone wants me to talk RH. Restoration Hardware. The maker of, oh, is this Red Hat or Restoration? Wow, Restoration Hardware, killing it. Well, let's see what the straddle was looking for. It's up $22. It was up $22. All right, so here's what the straddle was looking for into earnings. All right, so Restoration Hardware was looking for, I'm going to say $5, and I'm going to say a $9 move, $9.50 move, and it moved 22. Holy bananas! I think it's going to keep going. I think tomorrow you're going to see a little bit of. My guess is tomorrow it's going to be down a little bit, and that's going to be when I would want to buy calls. That's just my bet. I use the week of. What calls would I buy? Well, that's getting a little into the weeds, Renee. You're going to ask me tomorrow in the chat room. Trade idea of the week, Restoration Hardware. Maybe. I usually like buying out of the money, not in the money. That's me, Chris. Chris said buy the 70 calls. I usually like buying it out of the money because I'm looking for bang for my buck, and also low risk. How do you take snapshot? Is that in live vol? This is live vol. I'm a smart guy. Thank you, Chris. Would this work for just buying the stock too? It would, but why bother buying the stock when you could trade options? So if Straddle underperforms, then avoid purchase, and if Straddle outperforms, buy after. If Straddle underperforms, I generally go with the move, Jim. That tends to be the right way. Again, wait a day, let things shake out. There's always a little bunch of people that said, "Whoa, I made a bunch of money." I mean, think about it. If you bought Restoration Hardware and you made $22 yesterday, would you consider taking some money off the table? Trevor, that's a great question for the gold open mic. Do you talk about trading after earnings and what companies you like in the? Yes, we do, John. Do you talk about trading after earnings and what companies you like in a subscription package? Yes, we do. All right. So does anybody have any other questions? Worth your time? Finzer and AOBC both missed. What was the straddle pricing? I don't know. Pick one. I'm not going to look at both. Will this be repeated? I'm out of time. You will get to keep the recording if you buy it. Oh, where's the snapshot function in live vol? That's easy. Right here. Window to clipboard, window to file, region to clipboard. You can pick one. Finzer or AOBC, John. Yes, Andrew will be doing half of the presentation. I'll be doing the more straight buy, sell, smart trading. Here's AOBC. I don't know what they were doing after hours. Let's see. Oh, it's down $2. Looks like $2 after hours. And they were pricing in with the stock trading $17. So AOBC does not have weeklies. So that means I need to go back a month and look at where they were about a week ahead. So they were pricing in. They don't price in much. So this is not a super volatile stock. So they're basically pricing in the move here. And here's what I'll say is the 15, 17.5 strangle was, I'm going to call it 75 cents. The thing moved, 75 cents, and it was, so they're pricing at about a $2 move, and it moved $3. So now the key is what happens to implied volatility tomorrow. Probably it does not as good as live vol, but it's pretty good. Wendy, can you take a look at GC and CL? Will they continue head higher? Though this session is about earnings, thanks. We can talk about that. That'd be a chat room one that we can talk about. How about a stock where there is an unexpected announcement and the volatility is already high? That is an entirely different webinar, Nancy. Again, that's a good chat room question. If the volatility does not move, that tell you if the volatility doesn't move and there's an unexplained announcement or an unexpected announcement, what that does tell you is there's going to be a lot more movement. It is going to keep moving. Maybe not in any particular direction, but it is going to keep moving. I promise you that. All right. I'm a useful man, Nancy. All right, she gave me a smiley face. Any other questions before I let you guys go? All right. Well, worth your time? Thank you. All right. I'm glad to help. I love the feedback I'm getting tonight. It makes me very happy. So I will hopefully see you guys either in the chat room or what's included in the subscription. All right. Included in the subscription is access to our daily chat room. I put out a chat wrap every day, like a 7-minute video where I discuss the 3 best ideas I saw. We have a strategy letter where we actually follow along with trades that you get access to. And then we also, you also have the chat room all open all day. You can talk to each other. You get Saturday classes going forward. So all the Saturday classes in front of you while you keep your subscription are free, included with the subscription. We do 10 a year. So if all you want to do is catch out the Saturday classes, it's cheaper to have the subscription. All right. So we're doing this directional one. Then we're going to do a break. Our next one in October is going to be breakout trading. So how do you pick out a stock that's about to move? All right. Well, this was fun, and I enjoy trading funness. So if you've got questions, you can call me, mark@optionpit.com, 888-TRADE01. And otherwise, I'll what is the URL for the subscription? Go to www.optionpit.com/mentoring, and it's listed as Option Pit Live. I told you, give me an address and I'll send you a check. Right there. The way I do is in the morning, in the morning before the market opens, I come up with 5 or 6 ideas I really like. Then I go through those 5 ideas, then I funnel them down to 3 in the chat room, 3 really good ideas. And then generally speaking, I'll pick 1 to 3, or I'll pick 1 up to 1 trade I really like up to $3. Does that make sense? So really, I pick like 3 I really, really like a week, but I go through 3 good ideas every day. And my goal is to pay for the chat room, pay for your subscription every day. So for instance, today, I paid for the subscription by buying Goldman Sachs calls on the bottom. How do I come up with our trade idea? It's called, I've been looking at option markets for 17 years. And then I teach you what I'm looking for. That's part of it. Yeah. So I like to talk about how I'm thinking. Yes, I do look at VIX trades. My fund is primarily a VIX fund. So VIX is something I know very well. And here's one little hint, one thing I'll tell you. I think we're going to be up big tomorrow. UVXY, VXX, or VIX itself. Yeah, UVXY. I do a lot of UVXY, but I also use VIX itself, or I'll use VXX. All right. It's now 9 o'clock. No, I'd buy ES. I think ES is going to be up a lot tomorrow. All right. Have a good night. It's 9 o'clock Central. I am now officially a pumpkin. Have a good night. Love you too, Joe. You're the best. Platonically, of course. We'll be sending out the recording of this tomorrow. It'll be on the landing page. In the middle of the page, you'll have to scroll down a little bit to see it.